The world stage has been bustling with activity, witnessing a cascade of significant events that ripple across continents, influencing economies and political landscapes alike. What truly unfolds when the planet's most dominant economy, the United States, experiences even a minor ailment, perhaps just a cough? The repercussions can be profound. It's often said that if America gets a sniffle, the rest of the globe might just brace for pneumonia. The interconnectedness of our modern world means that economic tremors in one major region inevitably send shockwaves everywhere else. We're standing at a fascinating yet potentially precarious juncture in global affairs. From persistent inflation concerns haunting households and central banks, to geopolitical tensions reshaping alliances and trade routes, the chessboard of international relations is more complex than ever. Add to this the ongoing adjustments in energy markets following major disruptions, the intricate dance of supply chains seeking new equilibriums after the pandemic shakeup, and the rapid advancements in technology like artificial intelligence rewriting the rules of commerce and productivity. It's clear we are navigating through transformative times. How will these multifaceted challenges interact? Which nations are most exposed to the turbulence, and which might find unexpected opportunities amidst the shifts? We will delve into these pressing questions, examining the intricate web of global dependencies and potential fault lines. Stay with us as we explore the current state of play, dissecting the major events and trends shaping our world. We promise a thorough analysis, and the conclusions, which we will share at the very end, might offer some surprising perspectives. The global economic system is a vast, complex network. Think of it like an intricate ecosystem where the health of one significant part affects the entire balance. When the United States, historically the largest and most influential economy, faces headwinds, whether it's rising interest rates to combat inflation, shifts in consumer spending patterns, or policy changes impacting trade, the effects are rarely contained within its borders. The entire world often feels the reverberations. This isn't merely an academic observation. It's a lived reality for nations large and small whose fortunes are, to varying degrees, intertwined with America's economic trajectory. The sheer size of the U.S. consumer market means that a slowdown in American spending directly impacts export-oriented economies across Asia, Europe, and the Americas. Furthermore, the U.S. dollar's status as the world's primary reserve currency means that Federal Reserve policies on interest rates influence borrowing costs and capital flows globally. A stronger dollar can make debt servicing more expensive for emerging markets, while simultaneously affecting commodity prices, which are often denominated in dollars. The financial markets, too, are deeply interconnected. A significant downturn on Wall Street often triggers sell-offs in stock exchanges from Tokyo to Frankfurt. Therefore, understanding the potential consequences of shifts within the U.S. economy is crucial for anticipating global trends and vulnerabilities. We've seen numerous events unfold recently, painting a picture of a world grappling with significant change. Let's consider some of these major developments. Before we dive deeper into the specifics, we encourage you to subscribe to our channel and hit the like button. Your support is incredibly important for us to continue bringing you these analyses and helps our content reach a wider audience. Also, let us know in the comments where you're watching from. It's always fascinating to see our global community connect. Understanding the intricate links between the United States and the global economy requires looking beyond simple trade figures. Consider Mexico, a nation sharing not just a border, but a deeply interwoven economic destiny with its northern neighbor. While one might assume geographic proximity translates to a degree of economic independence, the reality is far more complex. Mexico's economy is profoundly tied to the rhythms of American commerce. A staggering 80% of Mexico's exports find their way to the U.S. market. That figure, 80%, warrants a moment of reflection. This isn't just about avocados and tequila. It encompasses a vast array of goods: automobiles assembled in Mexican factories, sophisticated electronics, and a wide range of agricultural products. These goods flow north to meet the demands of American consumers and businesses. This reliance creates a significant vulnerability. Imagine if that robust American demand were to suddenly contract due to a recession. The impact on Mexico wouldn't just be a minor slowdown. It could trigger a severe economic crisis. The ripple effects would be almost instantaneous. Key Mexican industries, particularly manufacturing and agriculture, would face immense pressure. Factories might reduce production or halt operations, leading to job losses. Farmers who rely heavily on exports to the U.S., cultivating fruits, vegetables, and grains specifically for that market, would struggle immensely to find alternative buyers, potentially facing ruin. This economic distress would inevitably translate into social challenges, exacerbating unemployment and pushing vulnerable communities deeper into poverty. Furthermore, the flow of remittances, money sent home by Mexican workers employed in the U.S., plays a critical role in supporting countless families across Mexico. These funds are not just supplementary income. They are often a lifeline, covering basic necessities like food, housing, and healthcare. A U.S. recession typically leads to fewer job opportunities and potentially lower wages for these workers, consequently shrinking the vital stream of remittances flowing back to Mexico. This dual impact, a sharp drop in export demand combined with reduced remittances, paints a precarious picture. The combination of rising unemployment, a potentially weakening currency making imports more expensive, and reduced household income could destabilize the Mexican economy significantly, pushing it towards a deep financial crisis. The question arises, could Mexico truly insulate itself and thrive independently if its largest trading partner stumbled significantly? Given the depth of these economic ties, the prospect appears challenging, highlighting the profound interdependence that defines the U.S.-Mexico relationship. The stability of one is intrinsically linked to the stability of the other, a fact underscored by decades of shared economic history and integration. Now, let's shift our focus northward to Canada, America's closest geographical neighbor, and another nation whose economic fate is deeply intertwined with the U.S. One might perceive Canada, with its abundant natural resources and highly developed social systems, as being better shielded from American economic turbulence compared to Mexico. It boasts vast reserves of oil, timber, and minerals, and its social safety net is often cited as a model of stability. However, this perception overlooks the sheer scale of economic integration between the two nations. Canada's economy remains exceptionally vulnerable to developments south of the border. The United States is, by a significant margin, Canada's largest trading partner. Approximately 75% of all Canadian exports are destined for the U.S. market. This trade relationship encompasses a wide spectrum of goods, ranging from crucial energy resources like oil and natural gas, to manufactured products such as machinery and vehicles, along with agricultural goods. The health of major Canadian industries is therefore directly linked to the purchasing power and economic activity within the United States. Should the U.S. economy enter a significant downturn, the shockwaves would travel north almost immediately. A slowdown in the U.S. translates directly into reduced demand for Canadian products. Consider the energy sector. Canada is one of the world's leading oil producers, and a substantial portion of its output flows directly to the U.S. A U.S. recession would likely lead to decreased energy consumption and potentially falling oil prices, directly impacting Canada's oil industry, a cornerstone of its economy, particularly in provinces like Alberta. The repercussions wouldn't be confined to oil companies. They would cascade through the economy, affecting employment, investment, and even housing prices in energy-dependent regions like Calgary and Edmonton. Beyond energy, the automotive sector, highly integrated across the border, would also suffer as demand for vehicles typically declines during recessions. Furthermore, Canada's financial and banking systems are closely linked to their U.S. counterparts. Financial instability or a credit crunch in the U.S. could quickly spill over, affecting lending conditions and investment flows in Canada. While Canada's robust social safety net can cushion some of the blow for individuals facing job losses, the sheer magnitude of an economic downturn, originating from its primary trading partner, could strain even the most well-established systems. Widespread business closures and layoffs could lead to increased pressure on public services and potentially fuel social unrest. In essence, despite its own strengths, Canada's economic survival and prosperity remain heavily dependent on the health of the U.S. economy. A major U.S. recession wouldn't just cause a ripple. It could trigger a potential financial catastrophe north of the border, underscoring the fragile nature of this deeply integrated economic relationship. The question of whether Canada could truly weather such a storm without the U.S. remains a pertinent one, with the evidence suggesting a significant degree of unavoidable vulnerability. Let's pivot across the Pacific to South Korea, an East Asian powerhouse renowned for its technological prowess and home to global industrial giants like Samsung and Hyundai. Given its sophisticated economy and global reach, one might assume South Korea possesses a degree of insulation from a potential U.S. recession. It's a leader in advanced manufacturing, particularly semiconductors and consumer electronics, and has cultivated diverse trade relationships around the world. However, despite these strengths, the South Korean economy remains significantly reliant on the economic health of the United States, exposing it to considerable risk. The U.S. is a critical market for South Korean exports. In the year 2023, exports to the United States constituted roughly 14% of South Korea's gross domestic product. While this percentage might seem lower than Mexico's or Canada's reliance, the composition of these exports is crucial. A large portion consists of high-value technology products, including the ubiquitous semiconductors that power everything from smartphones to data centers, as well as consumer electronics and automobiles. Major American tech companies like Apple and Intel are significant consumers of South Korean components, particularly memory chips and displays. If the United States were to enter a recession, consumer and business spending on technology and durable goods would likely decrease significantly. This reduction in demand would directly impact South Korea's key export industries. American tech firms might cut back on orders for semiconductors and other components, leading to reduced production and potential layoffs in South Korea's vital tech sector. Similarly, demand for South Korean cars, manufactured by companies like Hyundai and Kia, could falter in the U.S. market, impacting another major pillar of the nation's export economy. This wouldn't simply be a sectoral issue. A slowdown in these critical industries could trigger a broader economic deceleration across South Korea. Manufacturing output would decline, export revenues would shrink, and job losses could mount. The interconnectedness means that a downturn in the U.S. market for tech and autos sends ripples throughout the entire South Korean supply chain and related service industries. Furthermore, global investor sentiment often takes cues from the U.S. market. A U.S. recession could lead to capital flight from emerging markets, including South Korea, putting pressure on its currency, the won, and potentially leading to financial instability. While South Korea has strong economic fundamentals, its heavy reliance on export-driven growth, particularly in technology and manufacturing sectors where the U.S. is a key customer, makes it undeniably vulnerable. A significant downturn in the U.S. could severely test the resilience of the South Korean economy, potentially derailing growth and impacting economic stability. The intricate dependency on American demand, especially for its most valuable export goods, means that South Korea cannot fully decouple its economic fate from that of the United States. Now, let us turn our attention to South America's largest economy, Brazil. As a continental giant with vast natural resources and a significant domestic market, Brazil might appear, at first glance, to possess a greater degree of resilience against external economic shocks compared to smaller, more trade-dependent nations. It's a major agricultural exporter and has a diversified industrial base. However, despite its size, Brazil's economy is not immune to the effects of a U.S. recession, and its vulnerabilities lie in specific dependencies and internal challenges. While the U.S. is not as overwhelmingly dominant a trading partner for Brazil as it is for Mexico or Canada, it remains a crucial export destination. Over 20% of Brazil's exports head to the United States. Importantly, a significant portion of these exports consists of commodities: soybeans, iron ore, oil, coffee, and sugar. The prices of these commodities are often influenced by global demand, which in turn is significantly affected by the health of major economies like the U.S. If the United States enters a recession, the subsequent potential slowdown in global economic activity would likely dampen demand for these key Brazilian commodities. Falling commodity prices would directly impact Brazil's export revenues, squeezing a vital source of foreign currency. This is particularly critical for the agricultural sector. Soybeans, for example, are a cornerstone of Brazilian agriculture and exports. A decline in global demand, potentially triggered by a U.S. downturn affecting global consumption patterns, including demand for animal feed derived from soy, would place immense financial strain on Brazilian farmers and the broader agricultural economy. This could exacerbate existing problems in rural areas, potentially increasing poverty and unemployment, where agriculture forms the backbone of the local economy. Furthermore, Brazil relies on the global market for its oil exports. A U.S. recession contributing to a drop in global oil prices would reduce Brazil's oil revenues, putting significant pressure on the nation's finances. The Brazilian government already grapples with a high level of public debt. A substantial decline in export revenues, particularly from commodities and oil, would make it increasingly difficult for the government to service this debt. This could trigger a dangerous cycle. Reduced government revenue might lead to austerity measures, further dampening economic activity, while simultaneously increasing the risk of inflation and currency devaluation, weakening the Brazilian real. Such a scenario could destabilize the country's financial system and push it deeper into debt, making recovery more challenging. Compounding these external vulnerabilities are Brazil's internal challenges, including social inequality, political polarization, and bouts of high inflation. A major economic downturn triggered by external factors like a U.S. recession could easily inflame these existing tensions, potentially leading to increased social unrest and further hindering economic stability. While Brazil's economy has scale, its reliance on commodity exports and its existing fiscal challenges make it significantly vulnerable to a U.S.-led global slowdown. The impact could unravel economic progress and test the nation's social and political resilience. Let's journey now to the Middle East and examine the situation in Saudi Arabia. As the world's largest oil exporter and a nation possessing immense sovereign wealth, Saudi Arabia might seem uniquely positioned to withstand global economic turbulence. Its vast oil reserves provide a substantial cushion, and the kingdom has embarked on ambitious diversification plans under its Vision 2030 initiative, aiming to reduce its long-standing dependence on petroleum revenues. Projects like the futuristic city of Neom signify a concerted effort to develop new industries like technology, tourism, and entertainment. However, despite these significant investments and aspirations, the fundamental reality remains. Oil is still the overwhelming backbone of the Saudi economy and the primary source of government revenue. This deep-seated reliance on a single commodity creates inherent vulnerability, particularly to shifts in global energy demand, often influenced by the economic health of major consumers like the United States. If a U.S. recession were to occur, it would likely lead to a reduction in global economic activity and, consequently, a decrease in the global demand for oil. This reduced demand typically puts downward pressure on oil prices. For Saudi Arabia, whose national budget and extensive social programs are heavily funded by oil revenues, a significant and sustained drop in oil prices represents a severe financial challenge. Lower oil revenues would directly impact the government's ability to fund its ambitious diversification projects, potentially slowing down or halting key initiatives under Vision 2030. It would also strain the government's capacity to maintain its extensive public spending, which includes subsidies, public sector employment, and infrastructure development, all crucial elements for maintaining social stability within the kingdom. The Saudi government's legitimacy is, in part, tied to its ability to distribute oil wealth and provide economic prosperity and security to its citizens. A sharp decline in the revenue needed to sustain this could potentially lead to social discontent and test the existing social contract. While Saudi Arabia possesses substantial foreign currency reserves, accumulated during periods of high oil prices, which can act as a buffer during downturns, a prolonged period of low oil prices triggered by a global recession could significantly deplete these reserves. Furthermore, the broader geopolitical landscape of the Middle East adds another layer of complexity. Economic instability could potentially exacerbate regional tensions. Therefore, while Saudi Arabia is actively working towards diversification, its current economic structure remains highly susceptible to fluctuations in the global oil market. A major U.S. recession, by impacting global oil demand and prices, could pose a significant threat to Saudi Arabia's economic stability, its diversification agenda, and potentially its internal social equilibrium. The transition away from oil dependency is a long-term endeavor, and in the interim, the kingdom remains inextricably linked to the fortunes of the global energy market. Finally, let's consider China, the world's second-largest economy and a central player in global manufacturing and trade. China's economic miracle over the past few decades has been remarkable, lifting hundreds of millions out of poverty. While the country has made efforts to rebalance its economy towards domestic consumption and services, its growth model remains heavily reliant on manufacturing and exports, making it deeply sensitive to the economic health of its major trading partners, particularly the United States. The U.S. represents a massive market for Chinese goods, ranging from electronics and textiles to machinery and consumer products. If a U.S. recession were to significantly curb American consumer spending and business investment, the demand for Chinese-made goods would inevitably fall. This could lead to widespread factory slowdowns or closures, particularly in export-oriented coastal regions, resulting in potentially massive layoffs. The ripple effects would spread throughout the complex Chinese economy, impacting suppliers, logistics providers, and service industries. A severe slowdown in its manufacturing engine could significantly decelerate overall economic growth, a crucial factor for social stability in China. Beyond the export channel, China faces significant internal economic challenges, most notably an escalating debt crisis, particularly within its vast real estate sector, and demographic pressures from an aging population. The country has fueled much of its past growth through extensive borrowing, both by local governments and corporations. An economic slowdown triggered by falling external demand could make it much harder for borrowers to service their debts, potentially leading to defaults and financial instability. If global markets contract due to a U.S. recession, attracting foreign investment, another crucial component of China's economy, could become more difficult, further straining its finances. Less money flowing in could exacerbate the debt crisis and hinder the government's ability to manage economic challenges. The social fabric could also be tested. Rising unemployment, particularly among young people, combined with financial hardship, could fuel public discontent and increase pressure for political or economic reforms. While the Chinese government possesses significant resources and tools to manage economic downturns, the sheer scale of its economy and the depth of its integration with the global system, especially the U.S., mean that a severe American recession would pose an immense challenge. The combination of falling export demand, a precarious debt situation, and potential social instability creates a scenario where China's economic resilience could be severely tested. A U.S. downturn wouldn't just be an external shock. It could amplify China's existing internal vulnerabilities, potentially leading to a period of significant economic uncertainty and slower growth. So, what can we conclude from this global tour of economic vulnerabilities? The interconnectedness of the modern world economy means that significant downturns, particularly in a linchpin economy like the United States, are rarely isolated events. The 6 nations we've examined, Mexico, Canada, South Korea, Brazil, Saudi Arabia, and China, each face unique challenges, yet they all share a significant degree of exposure to potential U.S. economic instability, albeit through different channels: trade dependence, reliance on remittances, commodity price fluctuations, or integrated financial markets. For Mexico and Canada, the sheer volume of trade and integrated supply chains with the U.S. creates immediate vulnerability. South Korea's reliance on U.S. demand for its high-tech exports poses a significant risk. Brazil and Saudi Arabia, heavily dependent on commodity and oil exports respectively, are susceptible to price drops triggered by slowing global demand. China faces a complex mix of risks stemming from its export reliance, its internal debt burden, and the potential for social instability if growth falters significantly. The old adage holds true: when the dominant global economy experiences difficulties, the effects ripple outwards, often amplified in nations with specific dependencies. This isn't to say a U.S. recession guarantees collapse elsewhere, as national resilience, policy responses, and diversification efforts play crucial roles. However, it undeniably highlights the significant risks inherent in our deeply globalized system. These potential crises underscore the need for countries to build economic resilience through diversification, responsible fiscal management, and strong social safety nets. For individuals and investors, it emphasizes the importance of understanding global economic trends and managing risk accordingly. The coming years may test the stability of this interconnected world in ways we haven't seen in recent times. Thank you for joining us on this analysis. Remember to like this video, share it with anyone interested in global economics, and subscribe to our channel for more insights. Let us know your thoughts in the comments below. Where are you watching from, and which country's situation concerns you the most? Hashtag global economy, recession risk. U.S. economy. Brief description. Analysis of how a potential U.S. recession could impact 6 major world economies: Mexico, Canada, South Korea, Brazil, Saudi Arabia, China, due to global interconnectedness, trade links, commodity reliance, and debt vulnerabilities. Hard news, hard politics, economics, world news, finance, geopolitics, USA, recession, China, economy, Europe, global trade, stock market, investing. 5 YouTube title options. 1. 7 signs. The next global crash is unfolding. U.S. recession. Domino effect. 2. Warning. 6 nations teetering on collapse if the U.S. stumbles. 3. Mexico, Canada, China. Why a U.S. cold could give these 6 countries the flu. 4. Global economic meltdown. 7 fault lines threatening your finances. 5. Beyond the headlines. The 7 real threats to the world economy in 2024. 10 YouTube tags. Global recession, economic forecast, U.S. inflation, China economy, energy crisis, supply chain disruption, geopolitical risk, emerging markets, commodity prices, international trade, fun. Fact. YouTube time codes, niche search queries. 000 joules. Current global economic interconnectedness, explained. 55. Why is the U.S. economy important globally? Impact of U.S. economy on Mexico. Exports and remittances. 0338. How U.S. recession affects Canadian trade and energy sector. 0450. South Korea. Tech sector. Vulnerability to U.S. demand. 0646. Brazil. Commodity exports. Risk from global slowdown. 0747. Saudi Arabia. Oil. Dependence and vision. 2030 challenges. China manufacturing and debt crisis. Linked to U.S. market. 1040. Conclusion. Assessing global vulnerability to U.S. recession. 1135. Call to action and final thoughts. Clickbait phrases. 1. Is your country next to collapse? 2. The economic tsunami heading your way. 3. They warned us. The global breakdown begins. 20 image prompts. 1. Abstract image of interconnected global network lines glowing red in the U.S. section. 2. Graph showing U.S. inflation rates spiking upwards. 3. Image of the U.S. Federal Reserve Building with storm clouds overhead. 4. Busy U.S.-Mexico border crossing with fewer trucks than usual. 5. Mexican peso currency symbol looking weak or cracked. 6. Maple leaf flag superimposed over a declining economic chart. 7. Oil pipeline running from Canada to the U.S. under a gray sky. 8. Samsung or Hyundai factory with reduced activity. 9. Close-up of a complex semiconductor wafer with a crack graphic. 10. Aerial view of Brazilian soybean fields with concerned farmers. 11. Iron ore mine in Brazil with idle machinery. 12. Saudi Arabian oil field with pump jacks slowing down. 13. Futuristic cityscape of Neom looking stalled or under construction. 14. Cargo ship traffic jam outside a major Chinese port. 15. For sale signs in front of Chinese apartment buildings, representing real estate crisis. 16. Dominoes falling, starting with a U.S. flag domino hitting others, Mexico, Canada, etc. 17. World map highlighting the 6 mentioned countries in red. 18. Split image. One side showing a bustling Wall Street, the other showing worried faces from different countries. 19. Graphic illustrating the flow of remittances decreasing. 20. A visual representation of global supply chains breaking apart.